Jeff, I want to get this out of the way because I know there's a lot to talk about in oil, and that's really the reaffirmation of a gold call. We're here at 1,700. A lot of people are really on board the buy gold call. Reaffirm that? Is it still a buy gold call?
Yeah, absolutely. I think one thing that's interesting in the midst of all of this risk-on rally is that both real rates as well as gold have remained very stable. And particularly if we start to think about upward pressure on nominal rates, it'll likely be translated into lower real rates as your inflation break-evens begin to widen. That'll push gold higher. Also, when we think about what people are focused on is really tail risk inflation right now. Not that they think there's going to be inflation in the next, let's say, 12 months, but thinking about what does the outlook look like going forward, particularly with all the stimulus in the market. One negative on gold is the consumer demand in emerging market Asia. The numbers recently out of India were very weak. China's been slow to return to these markets. We think once you see that come back, this thing can easily go above 1,800.
With all the dynamics out there, including the dynamics in oil, what is the marginal central bank appetite to buy the next bar of Currie gold? I mean, what are the central banks going to do here?
Actually, the central banks have been absent. The emerging markets were the ones that were big buyers over the course of last year. You look at their finances right now, if anything, they have liquidity issues and are trying to raise cash. But they do it typically through the lease markets as they did back in April. In terms of our outlook going forward, we've taken out that strong demand from central banks, but it's being replaced strong investment demand, particularly from developed market consumers. They're the ones who are really pushing this, which is why if we get that emerging market consumer in there, that's what's going to really take you up to the next leg.
Jeff, how much do you look at some of the other metals, or how much do you look at, for example, global iron ore market? I know that there were many mines that had to close down because of infections of COVID-19. Does that bring us to the brink? Is it on a knife edge because of the halting of some of these mines?
The metals are the star performer in all of the risk assets, whether if it's copper, iron ore, or capital goods more broadly. One of the key reasons is not only what you're talking about in terms of supply disruptions, but Chinese demand. You look at copper during the month of May, Chinese demand was up 29%. Let me repeat that, 29% year over year. We look at iron ore or steel demand, it's up somewhere around 7.5% year over year. Given the fact we're just going through this corona crisis right now, those numbers are astonishing. What's driving it is local government policy. They needed to raise finances, so they sold property, lessened or loosened the restrictions around consumer demand for property, and as a result, we have a very strong property construction and infrastructure market going on in China right now that is pushing these markets higher. But I want to go back to your point about supply. Yes, there's concerns about right now you don't have scrap because the world's not creating scrap. But second of all, you have the mine closures. Both of those are likely to reverse, particularly with Brazil being off right now. We think that's going to put downward pressure on iron ore at the end of this year, but not with copper. Our target on copper, 12 months out, 6,500.